Today's lecture focuses on Chapter 13, Investing Fundamentals. But before we can invest, we got to establish why we want to invest in the first place. The first thing we must do is to establish goals. The goals must meet three criteria. 1, they must be written. 2, they must be specific. And 3, they must be measurable. So writing down specifically what you want quantifiably. So in the next 5 years, I want to invest $5,000 in stocks and hope to grow at a rate of 8% per year. That is an investment goal. So when we're establishing these goals, look at some of these questions you want to ask yourself, such as how much money do you need to satisfy your investment goals? And you should have goals for 5, 10, 15, 20, 30 years out, depending on how old you are. How long will it take for you to obtain the money? And really, most importantly, are you willing to make the sacrifices necessary to reach your investment goals? Wants versus needs. Finally, are your goals reasonable? So you may want to say that your goals, you want to have $300 million. However, that may not be reasonable. You got to make them sure that they are reasonable. So before we begin investing, it'd be important to perform, in essence, a financial checkup. Let's look at some criteria to look at. First thing is ethical concerns. Do you pay your bills on time? Because if you don't, you're probably not ready to invest at this point. Number 2, you got to balance your budget. And remember, we've created the budgets back in the first part of this course to really answer the question, hey, are you spending more than you're actually making? Third, do you manage your credit card debt? If you can't manage your credit card debt, now is not the time to be investing because you got high interest you're going to have to pay off. Fourth, start in an emergency fund. An emergency fund, generally speaking, is 3 to 6 months. I would go towards 6 months of living expenses. And as you can see, given what's going on right now, it's good to have an emergency fund because many people suddenly don't have jobs. And when you don't have a job, it's important that you have access to other sources of cash, such as a line of credit. And a line of credit is just a short-term loan that's approved before the money is needed. And if you're really desperate, you can take a cash advance out on your credit card or alternative sources that we've talked about before. As you know, the economy is constantly changing here. And as you know by now, economics is the study of how wealth is created as well as how wealth is distributed. As you can see from the second bullet point, there are factors that can affect the economy, not only your personal financial plan, but just how the actions of the federal government may take to maintain a healthy economy. Right now, the government's talking about giving everybody X amount of cash in order to get through the coronavirus. Because every country goes through what's known as the business cycle, and those are the peaks and troughs where we're either in economic expansion or a recession or even potentially a depression. So listen, it says to establish a larger than usual emergency fund at least 6 months. Remember, it said 3 to 6 months. I would go at least 6 months, if not even possibly out to a year. Know what you owe, because knowledge is power. Right now, for people who are spenders, reducing spending seems like if you have a spending problem, this is the time to break old habits and start new spending habits or lack thereof because you're at home more often. So once you've established these goals, you got to prioritize them. Really, at the end of the day, you can have goals, but how badly do you want to achieve your goals? Because you have investment goals, you may have fitness goals, you may have lifestyle goals, and how close to the top of the list are your investment goals? And again, are you willing to make opportunity costs or trade-offs, sacrifice some purchases to provide financing for your investments. You'd be remiss if you didn't take advantage of, to the extent you have a job, employer-sponsored retirement programs. Some employers, as we've talked about before, match. So you got to make sure that you are participating in elective savings programs to the extent they have them, such things as automatic payroll deductions, and just making an all-around extra effort. We talked about the time value of money way back in chapter 1. Many people fail to start an investment program simply because they only have small sums of money, but we have learned, especially that the younger you are, that small sums will grow over a long period of time over the principle of compounding. So depending on your rate of return will also make a real difference. So as we stated before, and we'll talk a little bit about again later on this semester, it's always important to look for investments that postpone taxes, such as individual retirement accounts or IRAs, or employer-sponsored retirement accounts, such as 401ks. Remember, a traditional IRA or a 401k is funded with pre-tax money, which means you do not pay taxes on those funds that you deposit. They grow tax-free. You take the money out once you take out the money, that's when you pay the taxes. With a Roth IRA, it's funded with after-tax money, which means the money you funded, you've already paid taxes on it. It grows tax-free, but the beauty of the Roth IRA is that you do not have to pay taxes when you withdraw that money upon your retirement. So let's look at different factors that will affect your choice of investment alternatives. First thing is safety on one end and risk on the other. So safe investments mean minimal risk of loss, sometimes no risk of loss. The opposite is risky investments. Risky investments mean a measure of uncertainty about the outcome, and there's different scales of risk, as you can see. A very risky investment is known as speculative investment. That's a type of high-risk investment that is made in the hopes of earning a usually large profit, notice in a short period of time. It's really important that you know what's called your own individual tolerance for risk, because the riskier the investment, the higher the return or the higher the amount you may lose. So it's really important to know what you think a rate of return on investment is. And here's the written way of calculating a rate of return, but I'd rather show you on the next slide, which gives you the mathematical formula, and we'll use an example on that. So, for example, assume that you invest $3,000 in a mutual fund. You'll never invest in a mutual fund, trust me, in chapter 15. Let's assume this mutual fund pays you income, $25 of income in dividends, and that the mutual fund appreciated in value from $3,000 to $3,275 at the end of the year. So you made $275 in appreciation. Your rate of return is 10%, because rate of return simply means in your numerator is the increase or decrease in value plus your income divided by your original investment in your denominator. So our numerator would comprise of two numbers. Our mutual fund increased by $275 plus an additional $25 of income dividends. That's $300 in your numerator. And our original investment, if you remember, was $3,000. When you divide that, it comes out to 0.10, which is a 10% rate of return per year. The next two slides, or three slides, we're going to look at components of the risk factor. One factor is inflation. And as you know, inflation is the general increase of goods or services over time. So let's say you have, for instance, $10,000 in a savings account that's earning you 2% interest. So you know you're going to get $200 of interest per year. However, if interest is actually at 3%, then is $10,000 times 0.03% is $300. So even though you earned $200 of interest, really you lost $100 in purchasing power because 200 minus 300 is negative $100. Second thing we want to look at is interest rate risk. And this is the value of an investment. With a fixed rate of return will either increase or decrease when overall interest rates in the economy either increase or decrease. So let's say you buy a bond, and we'll talk more about this in chapter 15, but let's say you buy a bond that has a 4% interest rate. And that's a guaranteed 4% rate of return while you own the bond. Well, if interest rates go up to 8%, the value of your bond has gone down because who wants your bond at 4% when you can go out and buy a bond at 8% and get a much higher rate of interest rate return? Other things to look at with risk is the risk that the business may fail. And you can see this right now. Businesses, because of the coronavirus, some businesses will fail. And if you invested in that business, there's a likelihood you may not get any of your money back. And obviously right now, with huge fluctuations in the overall market, there's a lot of market risk. And we want to talk about 3 types of market risks. Systemic risk is the first type of market risk. Under systemic risk, that's the overall risk in the market or the economy, which means when things go down, all stocks go down no matter what type of category. Unsystemic risk is a type of risk that affects a particular company or a particular industry. So that's the reason why you want to be diversified. So you want to own companies or invest in companies in a wide variety of businesses so that if there's unsystemic risks, such as right now in the energy sector, which is going down even more than normal, if you had all your eggs in energy, then you're in trouble. But if you're diversified, then you've spread out your risk. And finally, it's the behavior of investors. And as you know, right now, investors overall are very panicked. Right now, they're selling and asking questions later. So sometimes just investors can create market risk as well. Final type of risk is global investment risk. So listen, don't just put all your eggs in one basket. Don't just invest in US companies. A good way to diversify your overall portfolio is to invest in companies both in the US as well as in companies overseas. So let's look, things to look for in investments over the next couple slides here. The first thing we want to look at is investment income. So the safest investments here will produce investment income. So at the top part of the slide, you'll see these types of things. There's no risk of your initial investment going down. However, you're not going to make a lot in your investment. So such things as certificates of deposits or passport savings accounts, they'll go up, but usually they won't pay much, not barely, maybe even 1%. You can get investment income in the ones that are higher, but they also have a little bit of risk, such as municipal bonds, corporate bonds, some preferred or common stock, which we'll talk a little bit more about in a second, and mutual funds and real estate residential property. They will pay you income while you own it. Other things to look at in investment is growth. And this is more buying into companies that you're buying, not so much for the investment or dividends they give you or interest they give you, but the idea that the underlying investment will appreciate in value. So think about companies that have gone up a lot recently, and now they've gone down, but they've gone up, such as Facebook or Amazon. You're not buying it for the income, you're buying it for the growth. Finally, an important thing to look at in investments is the notion of liquidity. And liquidity, as you should know by now, is the ability to buy or sell an investment quickly without affecting the investment's value. Real estate is not liquid because it takes at least a minimum of a month, if not longer, to sell it if you're lucky. But you can get in and out of a stock or bond sometimes within a matter of seconds. So Remember, we talked about diversification here. You can see asset allocation and diversification of your investments is important. And this is the process of spreading your assets among several different types of investments to lessen your overall risk. So I have money just in cash. I have money in stocks. I have money in bonds. I have money in real estate. I have money in collectibles. I've not only within stocks, I'm diversified. I have my stuff in oil stocks. I have stuff in financials, technology, healthcare, etc. So not just diversified within stocks, but diversified within a bunch of different assets. So the time factors we talked about in chapter 1 also is very important. The longer that you are invested, the better you have opportunity for increasing returns. If you're a young person, now is the time to invest, especially given the dramatic downturn in the stock market. And the type of investment should change with your age. We'll talk about this here on the next slide here, as this pyramid will point out. As you get older, you want to be at the bottom of the pyramid because you're going to have to draw upon these funds very quickly. So as you get older, you're going to have stuff in level 1 or financial security, such as cash or CDs or government bonds. The younger you are, you should be the higher risk, 3 or 4, such as growth stocks or even speculative stocks or other high risk investments, because you have a lot of time to make it back if it goes down. So the younger you are, you're not going to need that money right away. So let's look at a highlight or a roadmap of where we're going to go over the course of the next several weeks. Chapter 14, we're going to talk about stocks, or another name for stocks is equities. So equity means ownership. So when you own stock, you own ownership or equity. So equity capital is money that a business obtains from its owners, stockholders in a corporation. Okay. So as you can see, stockholders are owners of corporations and they share in the success of the company. Corporation sells stocks to its stockholders and is not required to repay the money obtained from the sale of the stock. Corporations can pay dividends, but they are not legally required to. They instead may retain all or part of the earnings or reinvest it. Some companies issue dividends, some do not. All corporations issue a type of stock called common stock. Common stock is the most basic form of corporate ownership. A few corporations issue a second type of stock. This is known as preferred stock. Owners of preferred stocks have preferential rights to two things: dividends and liquidation, which means if a corporation pays dividends, the preferred shareholders get paid before the common shareholders, and if the corporation goes out of business and is liquidated, the preferred shareholders will get paid before the common shareholders. We'll talk more about this in chapter 14. In chapter 15, we're going to talk about bonds, corporate bonds, as well as government bonds. Corporate bonds are bonds that, like the name implies, is issued by a corporation. Okay. A government bond is issued by a federal or state government. So it could be federal bonds or state bonds or municipal bonds. Those are issued by a government. So whether it's a corporate bond or a government bond, the holder of the bond is known as a bondholder. He or she receives periodic interest payments, and depending on the term of the bond. But if it's how long it is, they're paid semi-annually. So for instance, a $1,000 bond that pays 5% interest, which is $50 per year, gets paid semi-annually. 25 at the first half of the year, June 30th, and the year 25 at the second half of the year, December 31st. That income is given straight to the bondholder and is not reinvested in the bond. That's chapter 15. In chapter 16, we're going to talk about mutual funds, and I'm going to tell you about my disdain for mutual funds. In mutual funds, investors' money is pooled together and invested by a professional fund manager. So in essence, you buy shares in the fund, and then the fund buys shares of stocks. Oftentimes, Mutual funds are diversified to reduce risk, and there's a wide range of mutual funds from very, income oriented or safety to very risky and speculative ones. And your job is to match the mutual fund that fits your needs. However, there's a lot of fees with mutual funds that we will talk about in greater detail. In chapter 17, we're going to talk about another type of investment in real estate or real property. So real estate increases in value and eventually sells at a profit, but generally speaking, there's no guarantees. Usually there's an increase between 3 and 5% in the price of real estate is average. Some years it's less, some years it goes up, some years it goes down quickly, especially when there's a recession. Usually real estate is not a get rich quick scheme, but rather a long-term investment. And as with every type of real estate, probably the most important criteria is the location of the real estate. Let's talk a little bit more about real estate on the next slide. So before you make the decision to buy any property, you got to look at it. Is it priced competitively with similar properties in a similar area? To the extent that you can't pay cash for the real estate, what type of financing is available? How much are the taxes? Different real estate locations will have a different property tax base. What's the condition of the property? And also in the immediate houses in the immediate area, because that'll be important. We'll also, throughout our journey of investments, talk about other investment alternatives. We'll talk about speculative investments. And as you remember, speculative investments are high risk with hoping to earn a large profit and importantly in a short period of time. We'll talk briefly about options and commodities in chapter 14. We'll talk more thing about coins, antiques, and precious metals in chapter 17. So again, to recap, you got to have a plan for investing. And as I stated at the beginning of today's chapter, it's important to establish your goals, your investment goals, and determine how much money you need. So I want you to take a look at this list and really think about each of these steps, 8 steps that's articulated here. But you can't just have a passive role. One of the reasons why you're taking class is because you want to have some ownership over your investments. Your role in the investment process is crucial. So it's important that you make decisions about where you want to invest your money. And then not only do you do that, then you monitor your investments. You don't just put it in and walk away. Oftentimes I get students ask me, how do I find out about a good investment opportunity? Well, the first thing I'm always going to tell students is you got the best opportunity that I never had when I was starting, which is the internet. And I use searches. You can enter searches through search engines, or you can go to specific sites. I like Yahoo Finance, and as you're going to see, we use this a lot this semester. But just besides the internet, there are other sources of information. You can use newspapers such as the Wall Street Journal, news programs such as on CNBC, Bloomberg, or Fox Business. There are business periodicals. I tend to use Barron's, which is a weekly one. I subscribe to that. You can look to corporate reports, annual reports 10Ks, or quarterly reports 10Qs. And there are even investor newsletters that come out even on a daily or weekly basis as well. As you can see, as some of them are listed here. This concludes our lecture on Chapter 13, Investing Fundamentals.